I ran some numbers on a client recently the other day where they make $50,000 a year, have no debt, and they own a condo with a very modest mortgage on it. This client got an inheritance of about $60,000. With one major bank, he can qualify to buy $200,000 purchase price with $60,000 as his down payment. Okay. With another major bank, he can qualify to up to $300,000 with $60,000 down payment.
Yeah. What is up, you guys? Matt McKeever here, and today we're with Jacob Perez again, and we're going to be talking about the 3 biggest mistakes people make when it comes to getting mortgages. And I'm really excited to bring this to you guys. As you guys may remember, I actually did a video talking about my 3 biggest mistakes, and a lot of those involved lending, and a lot of it involved me just not asking enough questions or accepting the first no. So I'm really excited to have Jacob kind of present 3 more major mistakes that people make when it comes to getting a mortgage. So
yeah, thanks for having me, Matt. When it comes to mortgages, there's certainly a lot more than 3 mistakes that we see people making, but if we're going to start off here, I'll get right into it. The very first mistake that people make when qualifying for a mortgage is focusing on the interest rate instead of the underlying terms within the mortgage. So yeah, it might be great that you got 0.05 lower on your rate, and maybe your payment is $7 cheaper as a result of that lower interest rate, but does your mortgage come with accessory products like a home equity line of credit? If you're with a bank that doesn't offer a home equity line of credit and you're an investor, maybe you're doing renovations on the property, things like that, well, you're lacking something in your mortgage product from that. Okay. Also, when it comes to getting a mortgage, sometimes these really niche low rate products in the market come with some underlying terms that are really unfavorable. So I'll give you an example of a client we had pretty recently. We had a client, and I won't name the lender, but they had one of these, what I call teaser rates, with one of these low rate lenders, and they had come into a lot of debt in their life. So they had a lot of equity in their property. They had accumulated a lot of debt, whether it be credit card debt, phone bill, things like that. And they wanted to refinance their property to pay out this debt. So consolidating debt is a really normal transaction. It's a great, houses are a great opportunity to consolidate debt because you can pay out credit card debt that might be closer to 20% and leverage it on a house where you're paying maybe like 3%, something like that. So this particular client, we went to refinance their property, and it turned out that because they're in one of these low rate products, they were not able to refinance unless they had an accepted offer on another home, and they had to purchase that home with this lender. So all of a sudden, you can't get access to one of the best things about your mortgage, which is just a traditional refinance. Whether it's consolidating debt or doing renovations on your home, you're likely going to want to refinance at some point. There's a lot of good reasons why you might want to do that. So don't get so focused on that tiny interest rate. At the end of the day, if the bank is lending you hundreds of thousands of dollars for less than 4%, that's a gift. And you would never lend your money out for less than 4%. I don't know, I wouldn't know. What about you, Matt?
Absolutely not.
So just be mindful of, if there's a smidgen difference in the rate, have a look at the actual payments. Does this really change my life?
I know. Far too many real estate investors get that tunnel vision just on looking at the payments and like really trying, or focusing on the interest rate and not looking at the payments, I should have said, because when you look at the payments, another $5, $10 a month, it realistically makes no difference on your cash flow. And I know it's something that often comes up in the comment section on my videos is people debating the importance of interest rates. My view is very similar to Jacob's. Anything below 4% is a gift. It's just essentially free money. You can't go wrong. So I think it's really important, if you see yourself as a real estate investor, if you see yourself as someone that's going to accumulate multiple properties, and ideally over a short period of time, you need to understand the terms of those mortgages, because like Jacob kind of mentioned, even let's say you were looking at acquiring a property a year. After a couple of years, let's say you start running out down payments, often a lot of people will immediately start refinancing in order to get access to equity that's built up either through appreciation or debt down payment in order to use that for the next purchase. And if you're stuck in one of the mortgages that Jacob highlighted, you're not going to be able to do that. And that's a major issue for us as investors. So it's a big thing. I think when you're sitting down with your mortgage advisor or the person at the bank, talk through not just this deal, but the next couple deals to make sure that that mortgage product really is aligning with your long-term goals. Huge tip.
Absolutely. And when I speak with investors, I always tell them, if 0.2 or 0.05 or 0.1, if that difference in rate changes something with your investment, you bought the wrong investment.
100%.
So at the end of the day, your tenant's paying that interest, you're not paying that.
Yeah.
So yeah, maybe you lose a little bit in cash flow, something like that, but at the end of the day, you should be focused on buying the right properties, and getting mortgage products are going to keep you flexible so you can keep that going, type of thing. Let's move right into our second point.
Number 2.
This kind of fits in with this last point about interest rate, and the most common mistake, and this is kind of with first-time home buyers as well as a lot of investors, is it's getting a 5-year fixed rate with a major bank. Almost never should you ever get a 5-year fixed rate with a major bank. There's a lot of things that are wrong with this type of mortgage product. So right off the bat, the biggest issue with taking a 5-year fixed rate is the significant penalties that come with these 5-year fixed rates. So if you're a real estate investor where you might want to refinance to buy another property, to do some renovation, whatever it be, or you're just a first-time home buyer who you don't know if you're going to stay in that house necessarily in the next 5-10 years, going with a 5-year fixed rate at a bank is going to cost you a lot of money, not because it's a higher rate than what's being offered on variable at the current time, but because the penalty that come with a 5-year fixed rate, if you do break it, are about 4.5% of the mortgage balance. So just for context, if you have a $300,000 mortgage balance and you have a 5-year fixed rate at a major bank, what you're looking at to break that mortgage is about $13,500. Whereas if you go with the variable, it's approximately 0.5% interest. That's about $1,500. So right there, we just saved over $10,000 just by being on the variable as opposed to the fixed. Now, I'll give you some other statistics in the market. 6 out of 10 people who take the 5-year fixed rate mortgage break it before year 4.
Oh, that's actually really good to know.
Yeah, so we have a lawyer's office right beside our mortgage office, and I could probably survey the last 10 people who just got a 5-year fixed rate mortgage there, and I'll ask them, hey, do you think you'll break your 5-year fixed rate in the next 5 years? They'll all say no, and 6 of them are wrong. So that's just something to be mindful of with these 5-year fixed rates. The statistics are, I think, in Canada that people move on average every 3.8 years. So that also falls before the 5 years, right? And even for me, when I got my first mortgage, I remember putting in an offer. I got denied at one bank. I got denied at the other bank. Somebody referred me to a mortgage broker. I did get approval. I was super grateful. Didn't even ask any questions about the rate. They put me in a 5-year fixed rate. This was a rental property I thought I would keep for life, essentially. I did end up selling that property, took a penalty, not a big deal. And one other thing about the 5-year fixed rate, just to reiterate, if you are one of these people where, you know, if you hear a media article or a news station say that, you know, rates are climbing or something like this, if that's gonna really cause you stress and anxiety, I think that a 5-year fixed rate or a 1-year fixed rate is worth it for you in that sense, but you want to do it at a monoline lender, which is a company that lends specifically out for mortgages, because their penalties are significantly cheaper than the 5-year fixed rate penalties at the big banks.
Interesting.
So you might want to take a slightly higher fixed rate with one of these lenders, but the penalty is going to be significantly less. So you can save yourself that peace of mind, but also save yourself on some penalty costs later on.
Awesome. Yeah, so definitely check out those monoline lenders.
Yep, monoline lenders, which you can only get access to through a mortgage broker. And that leads us into our third tip, which is the biggest mistake, and that is not working with a mortgage broker. I know it sounds like I'm plugging myself a bit, but honestly, it's a no-brainer. I'll give you some detailed examples. So if you work with a mortgage broker, we probably brought this up in other videos. The mortgage broker has access to 30, 40 different banks, credit unions, and mortgage lending companies. Banks all underwrite their deals slightly differently. So you may be approved for one purchase price at Bank A and a completely different purchase price at Bank B. I ran some numbers on a client recently the other day where they make $50,000 a year, have no debt, and they own a condo with a very modest mortgage on it. This client got an inheritance of about $60,000. With one major bank, he can qualify to buy $200,000 purchase price with $60,000 as his down payment. With another major bank, he can qualify to up to $300,000 with $60,000 down payment. So if he walks into one bank, he may think buying another house is never an option for him because there's nothing in his town at $200,000. Whereas if he just went to the correct bank, which a mortgage broker can advise you of, he can go $100,000 higher in purchase price. So working with a mortgage broker, it's really simply you get access to all the options. So why would you not give yourself that access? Unless you want to take the time and run to 25 different banks and try to do it all yourself and give your paperwork to each person. You'll probably forget who you're talking to, not remember much at that point, but that's kind of the biggest mistake. So just to kind of recap, the first one was What was the first one? I already forget.
The interest rate. Tunnel vision on interest rate.
Yeah, exactly, right? Focusing too much on the interest rate, not focusing on those underlying terms that are going to have bigger impact. Tip number 2 is never do a 5-year fixed rate at a major bank.
Yeah.
And tip number 3 is always use a mortgage broker. You're going to get access to all the options, and they should be able to give you the best advice in the industry.
Yeah, I think those are great tips, guys. And for tip number 3 in particular, I think the real key there is getting multiple opinions, getting multiple options available. Far too often, people just go into whatever bank they happen to have a checking account with and use them as their mortgage provider. And I think that that's a major mistake. I think you should be getting references. I think you should be talking to at least a couple parties, similar to the same way you would get 3 quotes from a contractor. There's nothing wrong with getting 3 quotes, maybe 1 or 2 from a mortgage broker, 1 or 2 from a bank, but just learn your options, because you guys know one of the biggest mistakes I made was accepting a no from a bank, and they told me I need to go get a new job and get paid more in order to qualify for mortgage number 5. So I ended up taking like a year and a half, almost 2 years off of real estate investing, because I just thought that was the way it was. Turns out that was just specific to that bank's policies. Obviously, you guys know I'm very frustrated by that. So I think these were great tips Jacob provided. Thank you so much. If you guys want to get a hold of Jacob, you can jump in the video description down below. We'll have links to all his information, but otherwise they can hit you up on Instagram.
Yeah, hit me up on Instagram at Jacob Perez 10. Love to reach out and chat with new people, whether it's a phone call, in office, if you're in the Hamilton area. Always great to connect with more like-minded real estate investors.
Awesome. And so otherwise, until next time, guys, remember, making money is a team sport. There's more than enough in this world for us all to make it, but if you're not saving it, I mean, what's the point? Also, smash that like button. Thanks.